Hello everyone and welcome to the Market Compass. We're heading into the final stretch of the year and both equity and fixed income markets are holding up well, thanks in large part to growing expectations for lower interest rates. In September, the Federal Reserve turned the page in its rate-cutting cycle. While the easing technically began last year, it hadn't gained much traction in 2025 until now. What changed? Mounting signs of a cooling labor market have shifted the Fed's focus from inflation to employment, prompting a renewed push towards easing. In this episode, we'll break down what's driving interest rate expectations and what it could mean for your portfolio. Let's start with the labor market. The biggest shift in the Fed's thinking has come from signs of a softening labor demand. The unemployment rate is still relatively low at 4.3%, but job openings have now dipped below the number of unemployed workers for the first time since 2021. That's a signal that employers are becoming a bit more cautious. Other data points reinforce this trend. Payroll revisions showed that over the past year, the economy added about 900,000 fewer jobs than previously thought. And weekly jobless claims have been slowly picking up. Despite these signs of weakness, we don't expect a sharp deterioration. And why is that? First of all, slowing immigration is reducing labor supply, helping keep unemployment low. And also, labor data tends to lag market developments. The recent softening may reflect fallout from peak trade uncertainty earlier this year. As that fades and profit growth remains solid, hiring could rebound. While the labor market has taken center stage, inflation hasn't disappeared. In fact, it started to tick higher, but not alarmingly so. August inflation data came in about as expected. Tariff-related price increases have been moderate, and while goods prices are rising, we haven't seen a major spike. Services inflation, which makes up about 75% of the core inflation basket, is still trending lower, though progress has slowed. One potential upside of a cooling labor market is slower wage growth. Since wages make up roughly 70% of service sector costs, this could help inflation stay in check. The bottom line, we don't see a repeat of the 2022-style inflation surge. Tariff-related pressures should be temporary, and the broader inflation outlook remains manageable. So what does all this mean for Fed policy? The combination of labor market softness and manageable inflation suggests the Fed may not want to keep interest rates in restrictive territory for much longer. Most Fed officials view 3 to 3.5% as a neutral rate, basically where policy neither stimulates nor restricts the economy. We believe the Fed is now easing toward that neutral zone, and markets are already pricing in that shift. In past cycles, the market's response to Fed easing depended on whether the rate cuts were preemptive, what we often call insurance cuts, or reactive. Insurance cuts like those in 1995, 1998, and 2019 aim to support the economy before clear signs of trouble. They also tend to be bullish for equities. On the other hand, recession-driven or reactive cuts like those in 2001 and 2007-2008 often coincide with poor risk sentiment and weak market returns. Today's backdrop suggests an insurance cut. While labor demand appears to be cooling, the unemployment rate remains low and corporate profits and the economy continue to grow at a healthy pace. From a portfolio standpoint, which areas might be the potential beneficiaries? We think rate-sensitive and cyclical sectors, such as consumer discretionary, could be one. Also potentially mid-cap stocks, which offer exposure to growth without the volatility of small caps. And also emerging markets, which could benefit from a weaker US dollar as other central banks have or already are close to approaching a neutral stance. On the fixed income side, the renewed easing bias is already helping. The 10-year Treasury yield has dropped to the low end of our expected range of 4 to 4.5%. While inflation and debt concerns may limit how far long-term yields fall, intermediate-term bonds still offer attractive yields in our view. Lower rates should help sustain the positive momentum in markets, but of course, let's not forget, markets rarely move in a straight line. Expectations are high, and September and October tend to bring some seasonal volatility. We'd view any pullbacks as buying opportunities, especially with the potential for growth to re-accelerate in 2026. Tax cuts, deregulation, and lower rates could all work together to support the economy. As always, your financial advisor is a great resource to help ensure your portfolio is well diversified and aligned with your long-term goals. Thank you for watching, and we'll see you next month on the Market Compass.